Around the world, governments are stockpiling gold at a pace we haven't seen in over 50 years. This isn't just about balancing the books, it's a clear signal of a massive shift away from the US dollar. The real question is, what do they know that we don't? They're moving with a speed and scale that hints at a fundamental crack in the global financial system. The numbers are staggering, but the hidden reasons behind this frenzy are what truly matter. What we're witnessing is the quiet, deliberate preparation for a new financial reality. In this video, we're going to expose what that reality is, why it's happening now, and what it means for your savings, your investments, and your future. Let's kick things off with a startling fact. Central banks, the institutions that control the world's money, are buying gold at a historic, almost frantic pace. For 3 years running, they've snapped up over 1,000 tons annually. To put that in perspective, that's double the rate we saw just a decade ago. This isn't some minor adjustment. It's a structural transformation, a deliberate and sustained move to accumulate physical gold. The World Gold Council recently surveyed central banks, and a stunning 75% of them plan to keep buying gold over the next 5 years. These aren't speculative hedge funds, they're the world's most conservative financial institutions, and they are making a collective multi-trillion-dollar bet. So what are they betting on? Or maybe the better question is, what are they betting against? The answer is simple and deeply unsettling. They are betting against the global financial system as we know it, which for 80 years has been built on the US dollar. For decades, the world ran on dollars. Nations held US Treasury bonds as their main reserve asset and used dollars for trade, for oil, for practically everything. This gave the United States what many call an exorbitant privilege, the power to print the world's money, run huge deficits, and wield incredible geopolitical power. But that era is rapidly drawing to a close. The US dollar's share of global central bank reserves has fallen from over 70% in 2000 to just under 60% today, a multi-decade low. And where is that money going? A huge chunk of it is flowing directly into physical gold. This isn't just a trend, it's a quiet institutional bank run on the US dollar. It's a vote of no confidence in the long term stability of fiat currencies, money created by government decree, and a return to the one asset that has held its value for 5,000 years. Central banks aren't just buying gold because it's shiny, they're buying it because they see deep, perhaps irreversible cracks forming in the foundation of the global economy. They're getting ready for a world that's less stable, more divided, and dangerously uncertain. The problem then isn't just that they're buying gold. The problem is why they feel they have no other choice. To understand that, we have to look at the geopolitical earthquake shaking the world behind the headlines. The first and most explosive reason for this gold rush is the rapid trend of de-dollarization, a global movement to break free from depending on the US dollar. This isn't a conspiracy theory, it's the stated policy of a growing group of powerful nations. Countries like China, Russia, India, Turkey, and a host of other emerging economies are leading the charge. They're no longer willing to have their economic futures tied to the politics and policies of the United States. They are actively building a parallel financial system, a multipolar world where the dollar is just one currency among many, not the undisputed king. The single biggest catalyst for this was an event that sent shockwaves through every capital city in the world: the freezing of Russia's foreign currency reserves. Following the invasion of Ukraine, the United States and its allies did the unthinkable. They seized roughly $300 billion of Russia's reserves held in Western banks. In an instant, these assets, mostly in dollars and euros, were rendered useless to Moscow. This act, meant to punish Russia, had a powerful unintended side effect. It showed every other nation that their US dollar reserves weren't really theirs. They were a privilege that could be revoked at any moment. For countries that have political disagreements with the United States, this was a terrifying wake-up call. The dollar was no longer a neutral tool for trade. It had been turned into a weapon of financial warfare. Suddenly, holding US Treasury bonds looked less like a safe investment and more like a potential trap. What if your nation gets into a trade dispute? What if you pursue a foreign policy that Washington dislikes? The message was clear. Your dollar assets are only safe as long as you stay in line with US interests. This is exactly why gold has become the asset of choice. Gold, when held physically in a country's own vaults, has no counterparty risk. It can't be frozen by a foreign government. It can't be devalued by another country's central bank. It is politically neutral and universally accepted, offering true financial sovereignty. Holding gold is an insurance policy against sanctions and geopolitical pressure. China is the perfect example of this strategic pivot. The People's Bank of China was on a massive gold buying spree, adding to its reserves for 18 straight months until a pause in mid 2025. And those are just the official numbers. Many analysts suspect China's actual holdings are much larger. For Beijing, gold diversifies its massive reserves away from the dollar, protecting it from potential sanctions, especially with rising tensions over Taiwan. It also adds credibility to its own currency, the yuan, as it builds non dollar trade blocks like BRICS. But it's not just about Russia and China. This is a global phenomenon. Poland, a NATO member, has been a huge buyer, citing the need for financial security. In the first half of 2025 alone, Poland bought more gold than any other country, adding over 67 tons to its vaults. Azerbaijan, Kazakhstan, India, Turkey, and Qatar have all been major buyers. In total, 23 different countries increased their gold holdings in the first 6 months of 2025. This shows that the move to gold isn't just a strategy for a few rogue states, but a widespread reaction to rising global risk. The world is fracturing into competing economic and political blocs. In this new multipolar era, trust is fading. Nations are searching for assets that don't depend on the goodwill of a rival. Gold is the ultimate neutral asset in a world that is no longer neutral. Every ounce of gold added to a central bank's vault is a quiet declaration of independence from the dollar system. While geopolitics lit the match, the economic landscape was a tinderbox waiting to ignite. The second major reason central banks are hoarding gold is a deep and growing fear about the long term health of the global economy, especially the shaky fiscal and monetary policies in the West. They see three clear dangers: stubborn inflation, unsustainable government debt, and a loss of faith in so called safe assets. First, inflation. For years, the world's major central banks, led by the US Federal Reserve, printed unprecedented amounts of money, especially after the 2008 financial crisis and the 2020 pandemic. The idea was to stimulate the economy, but it massively expanded the money supply. Now we're all paying the price with sticky, persistent inflation that eats away at the value of our currencies. Gold, with its finite supply that can't be printed at will, is a natural hedge against this currency debasement. The second and even bigger fear is the mountain of sovereign debt. The United States government is now over $38 trillion in debt. That number is almost incomprehensible, sitting at around 123% of the nation's entire annual economic output, GDP. According to the IMF, it's on a path to hit a staggering 143% of GDP by 2035. To put that in perspective, America's debt burden is on track to be worse than that of Italy and Greece, countries that have long been symbols of fiscal trouble. For decades, the world gladly lent money to the US by buying treasury bonds, considered the safest asset on the planet. But that confidence is cracking. How can an asset be risk-free when the borrower is drowning in debt? Interest payments on this debt are now one of the largest items in the US budget, costing more than the entire defense budget. Foreign central banks see this. They are the biggest foreign holders of US debt, but their share of the treasury market has already fallen from a peak of over 50% down to just 30% in early 2025. They are quietly reducing their exposure to US IOUs and swapping them for tangible debt-free gold. For the first time since 1996, central banks now hold more gold than US Treasuries. Finally, a technical but crucial change in banking rules has made gold even more attractive. The Basel III International Regulatory Framework reclassified physical gold as a Tier 1 asset, putting it on par with cash and government bonds. This means banks can hold physical gold on their balance sheets with zero risk weighting, making it a much more efficient and desirable asset for them to own. Combine these factors: stubborn inflation, unsustainable debt, and new rules favoring gold, and the logic is crystal clear. Central banks aren't just diversifying, they're de-risking. They are systematically moving out of assets that are someone else's promise and into an asset that is a promise from no one. If you're finding this breakdown valuable and want to stay ahead of these major financial shifts, make sure you subscribe and hit the notification bell. We dive into complex trends like this every week, so you can understand what the world's most powerful institutions are doing with their money and what it means for you. To really get the significance of what's happening, you have to look back in history. The current gold buying frenzy is the biggest we've seen since the 1960s. That's no coincidence. That period, just like today, was a time of huge geopolitical and economic stress that led to one of the biggest events in modern financial history: the end of the gold standard. From 1944 to 1971, the world was on the Bretton Woods system. The US dollar was pegged to gold at $35 an ounce, and other currencies were pegged to the dollar. Foreign central banks could, in theory, swap their dollars for US gold at that fixed rate. This made the dollar the king of the financial world. But in the 1960s, the US started running huge deficits to pay for the Vietnam War and massive social programs. It was printing more dollars than it had gold to back them up. Foreign central banks, especially in Europe, got nervous. They saw the US was devaluing the dollar and started cashing in their dollar holdings for physical gold from the US Treasury. France famously sent warships to New York Harbor to bring its gold home. This created a run on the bank, draining America's gold reserves. By 1971, the situation was out of control. On August 15th, President Richard Nixon went on TV and announced he was temporarily closing the gold window, cutting the last tie between the dollar and gold. That temporary move is still in effect today. The parallels to today are striking. Once again, the US is running massive deficits. Once again, the world is splitting along geopolitical lines. And once again, foreign central banks are getting nervous about their dollar exposure and are aggressively swapping paper assets for physical gold. The dollar's share of global reserves is falling, just like it did in the years before 1971. The big difference is that today there's no official gold window to close. The link is already broken. But central banks are creating their own informal gold standard by choosing to hold gold as their primary reserve asset once again. The history of the 1960s shows that when faith in the world's main currency starts to crack, smart money moves into gold for protection. The actions of central banks today suggest they believe we're at a similar turning point. So, with all this geopolitical conflict and economic decay, why is gold the answer for central banks? Why not another currency or digital assets? The answer is in the unique properties of gold itself. First and foremost, gold has no counterparty risk. This is the single most important factor. A US Treasury bond is a promise from the US government to pay you back. Every other financial asset is someone else's liability. Gold isn't. A bar of physical gold in your own vault is a real asset that isn't someone else's debt. In a world of fading trust, that's its superpower. Second, gold is a proven store of value. For over 5,000 years across every civilization, gold has been seen as money and a way to preserve wealth. Fiat currencies are a modern experiment, and their track record is filled with failures and massive devaluations. Gold has outlasted them all. Central bankers who plan for the next 50 years, not just the next quarter, understand this history. Third, gold is liquid and universally accepted. The global gold market is deep and trades 24/7. A central bank can buy or sell huge amounts without crashing the price. More importantly, it's accepted as payment everywhere. It's the one asset that works across all borders, languages, and political systems. Fourth, it provides strategic independence. For an emerging nation, holding gold reduces its dependence on the decisions made at the US Federal Reserve. It gives them more freedom to run their own monetary policy without worrying about a sudden swing in the dollar's value wrecking their reserves. Some might ask, what about Bitcoin? While cryptocurrencies share some qualities with gold, like a finite supply, they lack the thousands of years of history and institutional trust that central banks demand. For an institution tasked with preserving a nation's wealth, the volatility and regulatory uncertainty of digital assets make them too risky for a primary reserve role right now. In short, central banks are going back to the oldest and most reliable form of money because they're losing faith in the modern experiment of unbacked paper currency. They aren't buying gold to get rich quick. They're buying it as an insurance policy against the weaponization of finance, against irresponsible governments, and against a future of unprecedented uncertainty. So, the world's most powerful financial institutions are making a massive coordinated pivot to gold. What does this mean for you, the individual investor trying to protect your wealth? First, you should see the actions of central banks as a giant flashing warning sign. They are the ultimate smart money. When they make such a decisive, historic move, you should pay attention. They are the canary in the coal mine, signaling that dangerous gases are building up in the global financial system. They are telling you through their actions that the risks of keeping all your wealth in paper assets, cash, stocks, bonds, are rising dramatically. The sustained buying from central banks also provides a powerful price support for gold. Central banks aren't trying to time the market. They are accumulating gold as a long-term strategic asset. This creates a structural floor under the gold price, limiting the downside and building a strong foundation for future gains. For your own portfolio, the message is clear. Diversification is more critical than ever. The reason to hold gold isn't to get rich quick, but to protect what you already have. Gold often moves in the opposite direction of stocks and bonds during a crisis, acting as a stabilizer for your overall wealth. In a world full of the risks we've talked about, holding an asset that's independent of the mainstream financial system isn't just smart, it's essential. Gold is your personal hedge against the very same risks central banks are worried about. It's protection against the inflation that eats away at your savings and the currency devaluation that lowers your standard of living. Owning physical gold or a gold backed product gives you a piece of the same security that entire nations are now scrambling to get. You don't need to believe in a full blown financial collapse to see the wisdom in what central banks are doing. You just need to recognize that the world is getting riskier. Their actions are a roadmap for how to navigate this new era. They are reducing their reliance on paper promises and increasing their holdings of a real time tested asset. For the everyday investor, the lesson is the same. In a world of growing uncertainty, owning a piece of the ultimate safe haven is a powerful way to secure your financial future. The great global gold rush of the 21st century isn't a mystery. It's a rational response to a world in transition. Central banks are hoarding gold because they see a future defined by a few undeniable truths. The weaponization of the dollar has shattered trust, the unsustainable mountain of Western debt threatens all paper currencies, and the return of geopolitical competition has made the world a dangerously unpredictable place. This isn't a temporary trend. It is a fundamental replumbing of the international monetary system. For decades, gold was dismissed by many as a barbarous relic. Today, it's being reestablished as the bedrock of national security. The world's largest financial institutions are sending a clear message. Paper money is a promise, but gold is possession. Their actions have created a structural shift in the gold market, providing a strong foundation for its value for years to come. The story of money is a story of cycles. The era of the dollar's unchallenged dominance is ending and a new, more uncertain chapter is beginning. The question to ask yourself is not whether you can afford to own gold, but whether you can afford not to. What do you think is the ultimate end game here? Is a new gold backed system inevitable? Let us know your thoughts in the comments below. And don't forget to subscribe for more deep dives into the forces shaping our financial world.